Okay, so let's look again at this planning summary to make sure we're comfortable. We have now gone and developed our audit strategy and calculated materiality. So we now know what would be considered material. So now I can go back into the information I understood from the client, its environment, its internal control. And I can now go and say, based on my understanding, could there be a risk here? Yes. Could that risk be material? Yes, because now I've got my materiality calculation to be able to assess if there's a risk of misstatement, whether that misstatement could result in a material misstatement. If it were to materialize, guys, remember, we're just looking at risks currently. And then, when I do this assessment, I must just decide if I feel like that risk could affect the financial statements as a whole or lots of assertions in those financial statements, or whether I believe that it would just affect an account or a couple of accounts that I can pin that risk specifically to. Okay, so let's go and identify and assess the risks of material misstatement at the two levels. Our first thing is we need to understand what a misstatement is, and then obviously what a risk of material misstatement is. So a misstatement, guys, is the difference between the amount or the classification or the presentation or the disclosure reported in the financial statements and the amount, classification, presentation or disclosure that is actually required by the applicable financial reporting framework. So it's basically saying, have they recorded it differently to what IFRS requires? And if it's not necessarily IFRS, if it's what the Companies Act requires, or is it what the regulations require? So has something been recorded differently to what it should have been recorded? And if that is the case, there is a misstatement. Okay? Because this we're only going to pick up when we do our testing, when we perform in terms of the audit. But I'm not at that stage. I'm in the planning stage. So what I'm looking for is risks that there could be a misstatement. So I am looking for a risk that there could be a misstatement. And then all I'm saying that if that misstatement were to materialize, it does actually happen, is no longer a risk, it does, then would that actually be material? So I'm not going to say, I'm not going to look for all risks of misstatements. I just want to look for risks that could result in a material misstatement. And guys, remember, from materiality, we understand that it could be quantitative and or qualitative. So when I'm looking for risks at this planning stage, I'm going to look at whether the risk could result in a misstatement in excess of performance materiality, but I'm also going to look at whether this misstatement would be of a significant nature to the users that they would want to know about it irrespective of its actual amount. And here's just a few examples of misstatements. So maybe the amount is recorded incorrectly. If this is what we're looking at, we would be considering it from a quantitative point of view. So the rand amount is wrong. Maybe it's classified incorrectly. Now this might be qualitative. So an example, they classify other income as revenue. It still sits in the statement of comprehensive income. It doesn't affect your net profit, but for the users, they want to know what is revenue. So the fact that they've gone and put other income in revenue, doesn't matter what the amount is. It's a concern from a nature perspective. What else are these directors potentially misclassifying to deceive the users? If your item is presented incorrectly or disclosed incorrectly, once again, it may not be quantitative, but it is important to the users to present and disclose correctly, and by not doing that, the users are being misled. So later on, when we look at the Companies Act and it says that directors' remuneration must be disclosed in the financials, if they don't disclose that, then that's non-compliance with the Companies Act. So that is material to the users because they want to know that you're complying with the legislations. And if you're not, even if the amount is insignificant, it's extremely important to them that you are not. So it would be qualitatively material. But we again are looking at risks of material misstatements. So if we break up that sentence, risks of material misstatements, we split it into two types of risks. Inherent risks and control risks together make up the risk of material misstatements in the financial statements. So what are these two risks? Inherent risks are the risk that the financial statements or a transaction or an account balance or a disclosure could be misstated because of its nature. So, revenue could be misstated. Why? Because revenue is, first of all, quite complex with the change in the revenue standards, but second of all, it's a class of transaction that your users look at. So management might want to misstate revenue because they know people want to see high revenues. That has a way higher risk than something like other income. Doesn't carry that same weight because your users aren't so focused on an other income account. They want to know that revenue is doing well. So an inherent risk is a risk that something could be misstated purely because of its nature. So some examples, if we think of the financials in their entirety. If this company has got additional industry regulations they have to adhere to, there is going to be an inherent risk that they have not adhered to those, and therefore all the balances and transactions could be misstated. If we are looking at a group of financials, as soon as we see the word group, there is a risk that the consolidated financials are misstated because potentially the holding company and the subsidiary have not been correctly consolidated. So once again, the nature of the fact that they have a group brings about risks that don't exist if you've got an individual company. So we've got to look for inherent risks, and then we need to look for control risks. And these are now the risks that something could be misstated, because the controls that were put in place to stop risks are not working. So, they have internal control. They have control activities over the information system, but they aren't working, which means the sole reason for putting that control in place now can continue. Remember, they put a control of authorization in place to stop fictitious transactions. If that control does not work, what happens? Potential fictitious transactions. Doesn't mean there will be fictitious transactions, but there could be, because the control is not stopping them like it was supposed to. So, in order for there to be control risk, guys, there must be controls that are not working. They are not preventing or detecting and correcting the misstatements that they were potentially put in place to do. So guys, risk of material misstatements is solely linked to the financials. The client's financial statements. It's got nothing to do with the auditors, in that we can't prevent it or stop it or control it. This is purely the control of the business. They have to look for inherent risks. They have to put controls in place. And if they haven't picked up inherent risks, well, we will pick up that there could be a risk because of something's nature. And if they haven't put a control in place, we will see that inherent risk still there, not being addressed. Where we as auditors have some control is in the detection risk part of audit risk. So this is your entire audit risk equation, the risk that we express the incorrect opinion, and it is linked to two parts. One, there's potentially a risk that the financials are misstated, which is the risk of material misstatements in the financials, and two is the risk that we don't detect. This risk of material misstatements. If we detect all the risks of material misstatements, then audit risk will be at an acceptable level because we detect all the problems. It's the risk that we don't detect them that is the auditor's components of audit risk, and that's your detection risk. But guys, we're in the planning stage. We're not looking at the whole audit risk equation, because this detection risk part is something that we are going to be focusing on when we get to the performing stage or to the audit planning stage. So in the audit plan, we will address detection risk and then we will physically perform it. What we are looking at in the planning now, in terms of our audit strategy, is identifying the inherent and control risks within the business. And if we look at our standard, it says we need to identify and assess the risks of material misstatements through understanding the entity and its environment and internal control, which means that we should pick up inherent risks through understanding the entity and its environment, and we should pick up control risks through understanding their internal control. We've done both the understanding of the entity and its environment and the understanding of internal control. So now what I want to do is go and put down what we needed to understand about the entity and its environment and what we needed to understand about internal control, and link what our understanding is to risks. So we can see that when I'm in a scenario and I see that they've got this specific financial reporting framework, and I see they've got additional regulations, and I see that they've got a group, I automatically think about the specific inherent risks. And when I see in a scenario that their control activities are not working, or that management integrity is lacking, so their control environment is weak, I automatically see the control risks. And I am therefore able to identify the risks of material misstatements because I understand inherent risks and control risks, and I'm able to make the connection through understanding the entity and its environment to those risks.